Hey everybody, Luke Gromen, FFTT. Hope everybody had a great weekend. I know we had a pretty nice sunny weekend. It warmed up a little bit, so got out a little bit, which is always enjoyable. So, hey, with that, we're going to jump right into the questions. Thank you very much for joining me this evening. The first question is from JC. What are your thoughts on rate hikes? How many and across what date range until they go back to easing? In my opinion, the Fed, I think they're definitely going to do one in March. If that doesn't really get things going pear-shaped, then I think they'll get a second at the whenever the next opportunity is, whether that's April or May. I forget off the top of my head, but I don't think they're going to do more than two before they have to basically pause and then probably start moving towards reversing it. The next question from Minervus. Do you think that some countries can let inflation run hot better than others, and perhaps it is only the U.S. that can really pull it off? In many Anglosphere countries, housing inflation is already destroying the middle and lower classes. Is it less likely to succeed outside the U.S.? It's a great question. Probably, yeah. I think that's probably a fair assessment. I think those that have more diversified economies and bigger economies, and those that have a substantial amount of commodity production and or exports can probably weather it better. So, for example, I would think the U.S. can weather it better than the U.K. The U.S. can weather it better than the EU. I don't think, the U.S. can weather it better than Japan, I think. I don't think the U.S. will necessarily weather it better than, say, Russia. But I think it's a very valid point. From H, can you elaborate on how the price of oil in non-dollar terms, or in dollar terms, would be affected by a China-Russia oil deal denominated in a non-dollar currency? It's a complex topic. I could go on for quite some time, but I think the easiest way to think of it is in terms of balance of payments. So if the EU or China, for example, don't need dollars to buy energy, they can print euro, they can print yuan to buy energy, then that frees up dollars for other use for them. And that makes a dollar shortage or a currency crisis in either case much less likely. It gives China in particular another leverage with which to manage the yuan-dollar relationship. In other words, historically, a yuan-dollar, to manage that ratio, they had to do one of two things: either slow their economy or sell FX reserves or buy FX reserves. Basically engage in buying treasuries or selling treasuries to manage that rate. This yuan, buying oil in yuan, even on the margin, they don't have to buy most of it in yuan, then they're just on the margin. If they buy oil in yuan, it gives them the ability to manage the yuan-dollar cross rate through oil markets. Basically, this month we want to buy a certain percent in yuan and we want to buy a certain percent in dollars. And it can increase effectively, synthetically, the amount of dollars they have coming in, which then gives them an ability to manage the yuan-dollar cross rate. So it makes China and the EU's current accounts much more sustainable and stable over time. Now for Russia, I think the right way to think about it is like selling your house. If you were selling your house and you only had one buyer, the buyer has all the power. If you have multiple buyers, then the seller has the power. They can go with the best bid. Similarly, if oil is only priced in dollars, then Russia and their oil production is effectively a subsidiary of the U.S. government and the Fed. But if it is priced in multiple currencies, then Russia can sell amongst basically multiple bidders different currencies, whichever currency is the best. It forces the dollar to actually compete on its merits, and against creditor countries, it doesn't compete so well. And what I mean by that is you need a certain amount of dollars to pay your debt, granted, but after that, the Americans don't make anything on net. And so you can sell some in euros and you can get German Mercedes-Benzes, you can get Airbuses, you can get etc. Same with China. You can buy Huawei 5G equipment, etc. For the Americans, we do some software, we do some weapons, and certainly that has been a big one. But we do Boeing aircraft, but on net, we're a net debtor. And so the way to think about, as it relates back to the dollar price of oil question, I think is ultimately if you start pricing oil in multiple currencies, it's going to start to move the global currencies towards trading based on their balance of payments, based on their current accounts. Those with the biggest current account surplus should rise over time. Those with the biggest current account deficits should fall over time. So euro, yuan, yen should rise against dollar sterling and pound sterling if we just broke it down in the SDR basket. So at any given moment in time, again, it would depend. I don't think of it as, hey, it means the dollar price of oil is going to go up. Over time, it should make the dollar price of oil go up. Any given day, it's going to depend. I think it's better to think about as a management tool for balance of payments and for maximizing dollar flows for nations and regions such as that import oil but export on net, like China, Europe, and probably eventually Japan. Let's see, from George Faber, is China's debt to GDP strong enough to become the reserve currency over the next decade as Ray Dalio sees it? Will reserve currencies just be regionalized, or will there be a surprise move to a neutral asset such as Bitcoin over a 10-year time frame? Another great question. In my opinion, a mistake that many Westerners make is thinking that China wants a system like the post-1971 dollar system. In my opinion, they don't, because that would require them to hollow out their manufacturing base, which would be very politically unpopular there. It would require them to send the military abroad, which with single-child policy would be very unpopular there politically. And it would require them to run up foreign debt and give foreigners increasing stakes in their domestic industry, as China now has in ours. And that, too, would be very politically unpopular in China. And so none of these things China wants to do. And so I don't think they want this, but away from what I think they want, let's watch what they're doing. They are setting up a system where they are trying to be able to price commodities in their own currency, since that's their biggest import item by far. The biggest dollar outflow by far is commodities. So if they can switch that to yuan over time, it gives them tremendous flexibility. It basically rules out their ability to have a late 90s like Asia currency crisis. And it's quite frankly, in my view, the reason Kyle Bass got the shorting the yuan wrong was because yuan oil was successful. It has not gone away. It's still there. Small part of the market, but it only has to be a small part of the market. But anyway, back to the question. I think what we're watching China do, price commodities in yuan, settle those yuan to those that want it in Chinese goods, and then open up China's capital account on a limited basis, basically make the yuan convertible on a limited basis through two things, oil and gold at a floating rate in yuan. And so I think that when you look at what China's doing and then you look at Russia's FX reserves, where it is 13% yuan, 25% euro, 22% gold, I want to say 15% dollars, 20% dollars. That, I think, is where the world is going. Multilateral, like you said, regional reserve currencies, if you will. I think ultimately nations will reserve currencies based on their trade flows, right? If you do a lot of business with the Americans, you're going to have a lot of dollars. If you do a lot with the euros and none with the Americans, you're going to have a lot of euros and barely any dollars. And so I think that's where all this goes. And ultimately, as I said before, that's a system where relative currency values will increasingly be set by balance of payments. And the United States is the dirtiest dirty shirt by far because we ran twin deficits forever. And so that is, I think, ultimately what China wants, what Russia wants, what Europe wants. It's not what the Americans want, or at least the Americans in Washington. It'd be really good for America, actually, but it'd be really inflationary. Wall Street wouldn't like it either because it's not good for the bond market. I guess I would lastly say, could Bitcoin serve that role? Yeah, I think Bitcoin could serve that role. Gold looks like it's serving that role at the moment. Bitcoin, I think, could do it in a lot of ways better than gold. I think Bitcoin, if the U.S. did it preemptively, it could be a huge trump card we could play in the ongoing global geopolitical competition. I'd like to think our policymakers were that forward-thinking. There are people working on it, but I'm not optimistic that we're anywhere near that at this point, either using gold or Bitcoin. Let's see, from SR. Is the bond flippening happening in light of an apparent exodus by marginal players and the nascent 30% gain in Bitcoin? Is Bitcoin about to become the primary de facto risk-off asset? Is it about to happen? In my opinion, no. And it's we're what 3-4 days into this Bitcoin rally, so I don't want to play 5-minute macro. With that said, I think it is showing. I think it is very interesting to see Bitcoin bouncing as hard as it is, with interest rates rising as fast as they are, with negative interest rate debt falling as fast as it is. Negative interest rate debt globally, I think, fell 70% in the last 5 weeks, 50% last week alone, and Bitcoin's rising. So I think I've long been saying I think Bitcoin is not a bubble. Bitcoin is just the last functioning free market, the last functioning smoke detector that policymakers have not been able to disable. So maybe it's just a contra rally and it's going to go right back. Or maybe it's, again, suggesting, like it was suggesting in early December, like, holy cow, liquidity is getting taken out of the system. And obviously we saw a month and a half, 2-month stretch of high volatility, bond market sell-off, stock sell-off, etc. After Bitcoin fell. Are we now seeing, is Bitcoin now serving as a early warning of that the next marginal move by central planners will be more liquidity? I think it might be, but let's watch and see. Bond flippening, and just for the uninitiated, the flippening is a Bitcoiner term that is about when Bitcoin as a market cap gets bigger than whatever it's against, right? So silver flippening, gold flippening, etc., right? It hasn't flipped gold yet. It's flipped silver. It flipped others. Do I think the bond flippening is here? No. I mean, the bond market's $150 trillion. Bitcoin is, whatever, $800 billion. Now, with that said, do I think that $150 trillion bond market is the rocket fuel for Bitcoin? Absolutely. Absolutely. I think we are in a global sovereign debt bubble for the first time in 100 years. I think it's bursting. And I think rather than saying Bitcoin being a de facto risk-free asset, I think it's a neutral reserve asset at a time when global central planners are going to have to increasingly fully reserve that $150 trillion in debt. It's unsustainable. When I say fully reserve, what I mean is they are going to have to print money, buy the bonds, put them on their balance sheet. Right now, they own, whatever percentage of that $150 trillion they own. It almost has to, by definition, go up over time unless we get some miraculous productivity-enhancing technologies rolled out in the very near term. So I think it's very bullish for Bitcoin. I think it's very bullish for gold, too. Let's see, from Mark. If the Fed raises rates 5 to 7 times, as our gurus on the street are projecting, does Jerome and company have the stomach to watch U.S. equities drop potentially 50% plus? Is inflation now a bigger deal for the Fed, or will they do a January 2019 two-step and reverse course? In my opinion, no, they're not going to raise rates that much. If it was just equities dropping, and I don't think they would weather 50%, but if it was just 20%, 15, 20% on equities, that'd be one thing. But as we're seeing, it's highly likely it's going to be U.S. Treasury yields rising sharply as stocks crash. It's something we've been increasingly seeing since early 2018. We saw it in spades in 2020 and into 2021. We're seeing it again in the last 2 months, and they can't weather that, in my view. That's bonds selling off, stock selling off is the Achilles heel of the whole leverage system. And so I don't think they can weather that. But the Treasury part, I think, is the real key. Treasury yields rising as stocks fall. Inflation, I do think, is a bigger deal politically. I think it's very cynical on the part of the Republican Party, using it as a weapon against Biden, since really letting inflation run hot would be good for America. But it's an election year, so they're using it in a very cynical manner. Politics is politics. In my opinion, though, all the Fed can really do beyond a rate hike or two token rate hike is jawbone, given where we are with peak cheap energy, peak cheap commodities, as well as the debt and deficit levels for the United States in particular, but Western sovereigns more broadly as well. From Max, what in any way, if any, do the trucker protests in Canada and elsewhere change the calculus for central bankers continuing to try to ride 2 horses with 1 ass? I think it should be seen by them as a warning that future mismanagement of the economy will have increasingly acute problematic consequences, both domestically on the political side as well as on the social unrest side. That said, I don't think they're spending a lot of time worrying about it, partly out of their dogma and partly out of them being in the Washington, D.C. bubble, where they really don't notice things until it's very late or too late. From Russia, a lot of questions about Russia, Ukraine, and my thoughts. I don't have any strong feelings about the logistics, the intelligence reports about where Putin is, where Putin isn't, where Russian troops are, where they're not, etc. There's better sources for that. I would point you to them. Or even what Putin's intentions are in terms of empire building or not. My read is more intuitive, I guess, if you will. And that is that, number one, if Putin's position was as weak as a lot of our policymakers say, we wouldn't care. For example, we loved Russia while Yeltsin was there, effectively breaking up the country, selling it off in parts to Western favorable oligarchs or Western corporations. And if you want more detail on that, check out a 1998 article in The Nation magazine called "The Harvard Boys Do Russia." I also think that what we are doing with Russia is a total strategic misstep on our part. If we want to win or compete effectively against China, we need to separate Russia and China. And so if we are going to look at these two things, if China is the greater adversarial threat over time, as I think they are, then we need to split Russia and China. And so the move we are making is effectively pushing Russia and China closer together. So literally 180 degrees opposite of what is the smart, the better strategy over the long term. So maybe there's something else at play there that I'm missing. I don't think there is, unfortunately. I just think we're making a mistake. And then the last question from CM. Luke, I don't recall ever hearing you speak about foreign equities. Do you balance your portfolio with foreign equities? Any thoughts on a falling dollar being an opportunity to profit in emerging markets? I do have a few small, just foreign funds. It's not, I don't really speak about it because it's really a rounding error. To me, I haven't spent really very much time on them at all because to me, the biggest, most important macro theme has been and will continue to be the bursting global sovereign debt bubble, the first one in 100 years. And so all these sovereigns have problems within that context. And so for me, in my opinion, best way that I see in terms of positioning to benefit from this first bursting global sovereign debt bubble in 100 years is being overweight gold, being overweight Bitcoin, gold miners, commodities, and then industrials. I also have an elevated cash position right now versus what I usually do, just given volatility. I think I've mentioned before, I've been expecting volatility. We've been seeing volatility. My way of hedging it has been owning a little bit of call options on equity volatility, but mostly just carrying more cash. And so gold and commodities in particular have more of a quote-unquote foreign bent, if you will. I have talked a bit about Russian equities as all else equal, they'd be really attractive if you can kind of get over the sanctions risk, probably worth even just a small position. But I think the sanctions risk forces you to not get too far over your skis on that. So at any rate, that's all I've got for today. I appreciate everybody joining me. And as always, if you like these updates, check out FFTT Tree Rings, 10 Most Interesting Things, published every Friday. Ties in different themes that are either of interest on one-off basis, a lot of times tying into different themes we've talked about in the past, either confirming or denying, refuting things we've talked about. So you can learn more about Tree Rings, FFTT-LLC.com. With that, I'm going to sign off. Thank you very much for joining me. Everybody have a great rest of the week. Take care, everybody.